Hello everybody, Professor Barth here, Associate Professor of History at Arizona State University, coming at you with a new dollar report. We're going to take a look at the new inflation numbers today briefly, a little later in the video. Slightly higher than expected. We'll look at the implications of that. And then also, gold is exploding. Well, it's doing very well. Let's just say that, up 30% for the year. We'll also address that later in the video. But to begin, last month, September 17th through 18th, the FOMC, the Federal Open Market Committee, held a new meeting, and as probably all of you know, lowered the target federal funds rate, the upper limit, from 5.5% to 5%. So this was a reduction in half a percentage point, or 50 basis points. The FOMC also decided to retain the current schedule of quantitative tightening, reducing the Fed's holdings of various securities, namely treasuries and mortgage-backed securities. That will continue at $60 billion a month. More on that in a moment as well. But this was a pretty big move by the Fed. The Federal Reserve has not cut interest rates in a long time, and so to do 50 basis points in one sweep was a pretty big deal. The statement that the FOMC released on September 18th said the following: the committee has gained greater confidence that inflation is moving sustainably toward 2%. Job gains have slowed and the unemployment rate has moved up but remains low. And overall, they said the economic outlook is uncertain. So in light of that, they decided that this was necessary. The labor market's cooled. Inflation seems to be heading down to that 2% target rate that the Federal Reserve aspires toward. There's the unemployment rate. It went down a little bit last month, just slightly, but it's up about half a percentage point from where it was a year ago. But still, 4.1% historically is pretty low unemployment. And so there we have it. Federal funds rate down 50 basis points. And you'll see this is the first real action that the FOMC has taken on the target rate since the summer of 2023. And of course, this upward trajectory began in the spring of 2022. So we're beginning to see, looks like maybe the beginning of a decrease, a long-term decrease in the federal funds rate. Now, the minutes for that meeting were released yesterday afternoon, and the minutes are really fascinating to read because the minutes reveal some of the debates and discussion that took place at that meeting. And the minutes said this: almost all participants indicated they had gained greater confidence that inflation was moving sustainably toward 2%. Interesting here, almost all. So by implication, some participants did not have confidence that inflation was moving sustainably toward 2%. In light of the progress on inflation and the balance of risk, all participants agreed that it was appropriate to ease the stance of monetary policy, but the disagreement came on by how much. Do you do a half-point reduction, or do you only do a quarter-point reduction? Several participants remarked that reducing policy restraint too soon or too much could risk a stalling or a reversal of the progress on inflation. Now, being a monetary historian, I like to look back at previous examples in history, and the 1970s give us a pretty illuminating example of a situation in which inflation initially went up by quite a lot. You see here in early 1972, the inflation rate was around 3% or so. And then by early 1974, 2 years later, inflation was in double digits. pretty rapid inflation over a 2-year period. Well, the Federal Reserve responded to that increase in consumer prices by hiking up interest rates. Look at that. This was the federal funds effective rate from 1972 to mid 1974. The federal funds rate went from 3% to double digits. Okay, over 10%. That was a rapid increase, even really more rapid than what we've witnessed in the last 2.5 years. And it succeeded in bringing down consumer prices, or at least in decreasing the rate of inflation. Look at that. The inflation rate went down by the end of 1975 to roughly 6%, which is still very high, but it's not double digits any longer. So what did the Fed do? This was under Fed Chair Arthur Burns. Well, the Fed, almost as rapidly as it increased rates, decreased rates. And the federal funds rate just took a nosedive, so that by the end of 1975, it was back down to a normal rate of 5% or so. And Burns kept it at this level for, into 1977. Well, what happened? Inflation went right back up. So you had sort of this, again, used this analogy before with a beach ball that you're holding underwater, and then all of a sudden, once you let go that restraint, it just pops right back up again. And inflation operated in a very similar way. And when inflation returned in 1977-78 in a major way, it exceeded the previous wave of inflation in 73 and 74, forcing the Fed beginning in 1978 and then especially in 1979, and especially once Paul Volcker came into occupied the Fed chair, forced the Federal Reserve to hike rates to historic highs. So there is this concern, justifiably, among several participants that reducing policy restraint too soon or too much could risk a stalling or a reversal of the progress on inflation, just as you saw in the example in the 1970s. Now, continuing here from the minutes, a substantial majority of participants supported lowering the target range for the federal funds rate by 50 basis points to the upper limit 5%. Some participants noted that there had been a plausible case for a 25 basis point rate cut at the previous meeting, which was in July, and that data over the intermeeting period had provided further evidence that inflation was on a sustainable path toward 2% while the labor market continued to cool. So the meeting prior to this meeting on September 18th was July 31st. And there were some participants who, at that July meeting, wanted to cut rates by a quarter of a percentage point. That did not happen. And so now, at the September meeting, there was a push for 50 basis points. Let's make up for that inaction at the July meeting. Interestingly, what we found out yesterday with the release of these minutes was that there was disagreement among the FOMC about this question of, do we do 50 basis points? Look at this. Quote, however, noting that inflation was still somewhat elevated while economic growth remained solid and unemployment remained low, some participants observed that they would have preferred a 25 basis point reduction of the target range at this meeting. And a few others indicated that they could have supported such a decision. Several participants noted that a 25 basis point reduction, as opposed to what the Fed ended up doing, 50 basis points, would be in line with a gradual path of policy normalization that would allow policymakers time to assess a degree of policy restrictiveness as the economy evolved. A few participants also added that a 25 basis point move could signal a more predictable path of policy normalization. This is an interesting argument because it is strange. Like if you look at let's go back. You have this extended period where there's no alteration in the target range, and this period extended over a year, and then all of a sudden you're going to cut it by 50 basis points. You're not going to do it gradually and slowly. This is not a predictable Federal Reserve. Okay. Now, in reality, analysts were predicting a 50 basis point cut at this meeting, but the Fed here is a bit erratic, and again goes back to the problem I just keep hammering over and over again. This problem of a central board of bureaucrats and private bankers coming together and deciding the correct interest rate. But so you have participants on the FOMC who are like, wait a second, shouldn't we do, slow down a little bit here? Yeah, cut rates. We agree the interest rate should be cut, but let's do a quarter of a point instead of half a point. A substantial majority, according to a minute, said no, let's do 50 basis points. Powell, late last month at a conference, the National Association of Business Economics in Nashville, gave a speech, and he said this, quote, about the FOMC. This is not a committee that feels like it's in a hurry to cut rates quickly. It's a committee that wants to be guided. Ultimately, we will be guided by the incoming data, and if the economy slows more than we expect, then we can cut faster. If it slows less than we expect, we can cut slower, and that's really what's going to decide it. So a lot of people took this comment from Powell as a signal that the Fed is not going to have a repeat 50 basis point cut, that from here on out it's going to be a slower, more gradual process. So there we are. Why the hurried 50 basis point cut in last month's meeting? Well, a large part of it had to do with a scare that took place in August. The last dollar report that I recorded came on the heels of a stock market scare that began in Japan with the Nikkei index and then spread to the United States. You had analysts in the immediate aftermath of that saying that the Fed needed to make an emergency rate cut, and there was panic that the Fed had made a mistake by not cutting rates in July and all the rest. Well, the stock market bounced back. It wasn't the correction that some people, including yours truly, thought it might be, and so the stock market is at all-time highs. But the experience of that scare, I think, really just created this momentum for a major cut at the September meeting, and that's what they did. Now, the projection that the FOMC is putting forward is that by the end of this year, the upper limit will be 4.5%, which would imply there's two more meetings this calendar year. We have another meeting in November and another one in December, so that would mean a 25 basis point cut in November and another 0.25% cut in December. They're forecasting 4.5% by the end of this year, 3.5% by the end of next year, which would mean a 25 basis point cut at each of the 8 FOMC meetings next year, and then 3% at the end of 2026. They don't know all this. How do you even, these forecasts, you got to take it with a grain of salt, obviously. I looked at the minutes from the meeting in September of last year, and they predicted that the upper limit would be 4% by the end of 2024. Didn't happen that way, of course, but so got to take those forecasts with a grain of salt. New CPI numbers released today by the Bureau of Labor Statistics, and inflation is, declining. The rate of inflation is declining, but not as much as people had expected. This is a graph from the Wall Street Journal. In the gray, you see overall CPI, and then in the purple, core CPI. Core excludes food and energy, which are more volatile sectors of the economy, and so core especially is being stubbornly and persistently high. Here's the consumer price index year over year. So you do have a decline. I think it was 2.4%, and analysts had predicted it would be 2.3% if my memory serves me correctly. So year over year, inflation has gone down. It's still over the target rate, but when you look at core CPI, here, less reasons to be optimistic. Core CPI, again, because it excludes food and energy, actually tends to give a more accurate and representative picture of inflationary trends. And 3.3% is the year-over-year core CPI. It actually went up from the August numbers. So this remains a problem. And if nothing else, this is what is preventing the Fed from more aggressive rate cuts. And in fact, Powell has said as much in his press conferences that core, in particular, is preventing the Fed from cutting rates further. And then if you look at month over, here's another way to look at year over year, line graph, bar graph. It's not as high as it was in 2022, but it hasn't really made much improvement over the last year. And then when you look at month over month, core CPI, where's the improvement? Look at this. Basically, very little change since summer of 2023. And so what does this mean? I think what it means is that, yes, inflation, this isn't over. And if the Fed is overly aggressive in cutting rates, then yes, absolutely, there's a risk of inflation going right back up. Powell gave a press conference after the FOMC announced its decision to lower the federal funds target rate by 0.5 percentage point. He said, inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Our restrictive monetary policy has helped to ease inflationary pressures. And then to a reporter, he said, we're not saying mission accomplished or anything like that, harkening back to the George W. Bush fiasco in Iraq. Not saying mission accomplished, but I have to say we're encouraged by the progress that we have made. And to Powell's credit, although it's quite clear, as I've explained in many other videos, that the Federal Reserve caused that quantitative easing caused the inflation that we have undergone since 2021. Powell was, since spring of 22, was indeed quite aggressive in raising rates, and so I think that has something to do with the slowing down of inflation. And here we have, this was from the press conference, we know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. Part of me wonders if Powell was one of the participants who was lobbying for a 25 basis point cut instead of 50, but that's speculative. Then a reporter questioned Powell on whether, will zero or near zero rates ever return to our economy? And Powell answered, quote, "We're probably not going back to that era. My own sense is that we're not going back to that." And so if any of you are hoping for, a 2.5% rate on a 30-year mortgage, probably not ever going to happen in maybe in your lifetime. So Powell kind of put the kibosh on that. But it does appear that rates will continue to go down. Now, Powell said on September 30th at that conference in Nashville, "Our goal all along has been to restore price stability without the kind of painful rise in unemployment that has frequently accompanied efforts to bring down high inflation. That would be a highly desirable result. While the task is not complete, we have made a good deal of progress toward that outcome." So, like I said, the Fed was fairly aggressive in raising rates, and that seems to have, for now, stalled inflation. And has managed to do it without a spike in unemployment. Pretty impressive. However, as we'll see a few slides from now, there's no guarantee that an economic correction is not right around the corner. And in fact, actually, there's good reason to think that there could be a correction right around the corner. And if there is a correction in the next year and a half, the Fed is going to be faced with a really tough decision. Do you take rates down to zero again? And so we'll see. It's really completely unpredictable, the near and long-term future of monetary policy. The Fed is continuing its program of quantitative tightening. At its June meeting of this last year, the Fed slowed the monthly decline in its securities holdings from $95 billion a month to $60 billion a month. And quantitative tightening has effectively reduced the Fed's balance sheet from the beginning of that program in the spring of 2022 to the present day. The Fed's balance sheet has actually fallen by 21% from a peak of $9 trillion. It's sitting at around $7 trillion today. Of course, prior to COVID, it was around $4 trillion. So we're still the balance sheet is still much greater than it was prior to COVID. And right now it sits at around where it was in summer of 2020. Of course, all of this was at quantitative easing in 2021, which was just utter madness. I mean, I made so many videos about why are we doing quantitative easing in 2021? This is going to cause inflation, and sure enough, it did. And so, anyway, the minutes from the last meeting, quote, "Several participants discussed the importance of communicating, as I'm doing right now, that the ongoing reduction in the Federal Reserve's balance sheet could continue for some time, even as the committee reduced its target range for a federal funds rate." So yes, because of quantitative tightening, that has not ended. That continues. You're going to, even though the Fed has lowered its target rate, federal funds rate, this balance sheet will continue to, you'll continue to see a reduction in that balance sheet. So, and that has an impact on the treasury markets. We'll keep the yield on the 10-year relatively high for a while. I mean, we had very low yields in 2020 and 2021, and it's been sitting since summer of 2022 at around the 4 to 5% range. Now, zooming out, here's where we are. This is the federal funds rate since 2000. We're right here. Man, this is not happening ever again. Okay. I mean, this is, at the time, this is so bizarre. Like, what? How do you have rates at the upper limit? The upper limit was 0.25%. And then they did a repeat in 2020 into early 2022. Well, those days are over. And the gray here, you're like, what does that gray indicate? The gray is a recession. You had the dot-com bubble, or the bursting of the dot-com bubble, that is. The bursting of the housing bubble. COVID. I used this graphic last time in my last dollar report. I'll do it again. Every recession followed a peak in the Fed funds rate. You look at this. You had a peak here, recession. A peak here, rates were lowered, and then recession. Peak here, rates were lowered a bit, and then recession. Peak here, rates were lowered a bit, recession. Peak here, rates were lowered a bit, recession. Now that honestly was COVID, but peak here, rates are being lowered a bit. I mean, okay, so that's why I think a lot of these forecasts you have to take with a grain of salt. Okay, so like if there were to be a major correction, what's the Fed going to do? And based on the history, the Fed's going to lower rates. Now, I don't know if they'll ever go down to, and they'll lower rates drastically. I don't know if it'll go back to zero again. I somehow doubt it. But if there's a correction, coming next year perhaps or whatever, and the Fed is forced to take rates down to let's say 1%, and inflation hasn't yet been completely calmed by that point, that's when you could see that, again, that beach ball effect, inflation going right back up, just as you saw in the late 1970s. So now, gold's doing just great. This is since 2021, gold is up 50%. I mean, up through the end of 2022, you could get gold at less than $2,000 an ounce. Sitting at $2,600 an ounce now. In this calendar year, it's up 30%. So gold is performing very well. Compare that to the Dow this calendar year, and the Dow's done pretty well, 13%. I mean, a 13% return over the year is not bad, but gold has outperformed it. Now, what else has is silver. Silver up 35% for this calendar year. And Bitcoin. Bitcoin up 36% for the calendar year. Of course, if you bought your Bitcoin in March, it's not you're not seeing that 36%. Bitcoin, obviously a lot more volatile than some of the more traditional hard commodities. But if you zoom out, Bitcoin since 2021, beginning there, is up 70%. Now, again, you look at, there's so much volatility here, but it's held its own over the last year at these heights. And if you go back to 2020, that's a 500% increase if you had purchased Bitcoin in 2020. So, as I always say, don't speculate in Bitcoin. Don't put all your eggs in one basket. Please don't do that. Bitcoin could, go down to $20,000 next week. Okay, but it's holding its own pretty well. And again, I think everyone loves to prophesy the death and the end of Bitcoin, and it just will not go away, and it keeps hanging on and doing better and better, And so I'm a fan of Bitcoin, fan of gold, fan of silver. I think they're good. They're good assets to hold in uncertain times, especially gold and silver, particularly. So just wrapping things up here, you will see and have already seen a fall in a prime loan rate. The prime loan rate is the rate that banks lend to consumers who have good credit. So that's going to go down and will continue to go down as the Fed cuts rates. And the mortgage markets too, which peaked at almost 8% for the 30-year rate on average late in 2023, down to around 6%. That will possibly continue to fall. The problem is that home prices are just through the roof. Here's since January of 2020, which is right here on the graph, housing prices on average are up 50%. 50%. It's just massive. My wife and I bought our current home, in February of 2021, locked in a nice 2.5% 30-year rate. So yeah, I'm just locked in to that rate. But we bought at one price, and I checked Zillow the other day. Like, what does Zillow say what's the Zestimate? And it's 25% higher than the price we bought the home. And that was from 2021. But so that is, of course, a huge problem, even as mortgage rates go down. And I will say, if mortgage rates continue to go down, you're going to have a lot of people who felt like they were locked in at low rates because they bought here, and who will decide to sell because they can, buy a different home at a reasonable interest rate. So watch the housing market. Very, very fascinating to see what will go on there. Anyway, that's all. Hope this was useful, productive to watch. I'm going to record a video on Algernon Sidney for my Foundations of Western Political Thought pretty soon, probably later this month. So, hey, I had a new baby boy born August 15th. Beautiful boy, healthy, and mom is healthy. So, very thankful for that. God is good. God is good all the time. See you next time. Bye.